Welcome to the deep dive. So you've brought forward some really interesting news about the RBI's updated liquidity coverage ratio guidelines.
That's right, the LCR norms.
Exactly. And our mission today really is to unpack what these new rules actually mean for the banks and maybe more importantly, what openings this creates if you're looking at banking stocks.
Yeah, absolutely. And we've got quite a bit to draw on, some expos from Nimesh Shah, analysis from Jefferies, HSBC, ICRA, IFL Securities,
Uh-huh.
plus some good pieces from Business Standard, The Economic Times, CNBC, TV18, all pretty current, around April 21st.
Okay.
And the general feeling seems to be, that these final guidelines are actually quite a bit better than what was initially floated. It's a positive step, broadly speaking.
Right. So let's get right into it then. What's the fundamental shift? What's the key change in these LCR rules we need to grasp?
Okay, so the main thing is basically an easing of how much liquidity banks need to keep on hand.
Okay.
The biggest headline is probably the runoff rate for digital deposits. That was talked about potentially being 5%, maybe even stricter before that. But the final rule brings it down to 2.5%.
2.5%. Okay.
Yeah, so it signals the RDI sees these digital funds as, well, stickier than perhaps first thought.
That's a pretty big change. And I think the sources also mentioned something about deposits from non-financial entities, trusts and the like.
Yes, exactly. That's another crucial piece. The runoff rate there for things like trust deposits has been slashed. It was 100%.
Oh,
And now it's down to 40%.
40%. Okay, that's huge.
It really is. And this is important because, as we'll probably get into, it really affects which banks stand to gain the most.
Makes sense.
And just for context, remember there was that July 2024 draft. It even proposed an extra 5% runoff just for digital deposits. So we've come quite away from that.
Right. Quite an evolution in thinking.
Definitely. And Jeffries also noted it's kind of a broader easing, with other deposit runoff rates also moving from that 100% mark down towards 40%.
So, okay, less money needing to be parked, ready to go. That sounds like it must free up a fair bit of capital across the system. What are the analysts saying in terms of numbers?
Yeah, exactly right. HSBC put a number on it. They reckon around euro 2.2 trillion could be released into the system.
2.2 trillion.
The RBI itself, and Jeffries too, they're estimating maybe a bit higher, sort of in the 3.5 trillion range.
Okay, still very significant sums.
Oh, absolutely. Though it's worth remembering some earlier, maybe rougher estimates were thinking even bigger, like 6 or 7 trillion. So it's positive, but maybe a bit more measured than some initial hopes.
Got it. So trillions of rupees potentially unlocked. What does that actually, do for the banks day to day? How does it help them operate?
Well, fundamentally, it gives them more breathing room, more operational flexibility, less capital tied up meeting LCR rules means.
More money to lend out.
Precisely. More funds available for lending. And it could also help on the deposit side, maybe supporting deposit growth because they have more capacity. And if you connect that to the bigger picture, the RBI thinks this released liquidity could potentially boost overall credit growth by, say, 1.4 to 1.5%.
Okay, so a direct link to potentially more economic activity.
Yeah, and ICRA's analysis seems to support that too, linking these relaxed norms directly to potential credit expansion.
More lending, maybe better deposit growth.
That sounds like good news for bank profits, right? How does this feed into things like net interest margins or NIMs and their overall profitability?
Generally, yes. More liquidity and the ability to grow loans and deposits. That tends to be good for a bank's NIM.
Right, the spread they make.
Exactly, the difference between what they earn on loans and pay on deposits. So a healthier NIM usually flows through to better overall profit.
And are there estimates on that profit impact?
IFL Securities actually projected a potential uplift in profit after tax, the PIT, of somewhere between maybe 1% and 4% for banks, just from these rule changes.
1 to 4% PEAT uplift, that's not insignificant at all.
No, it's definitely meaningful. Is it an across-the-board benefit, though, or are some banks maybe affected differently, at least initially?
That's a good point. IAFL did flag that banks with a really high proportion of those digital deposits, they mentioned Federal Bank as an example,
Okay.
might actually see a bit of margin pressure at first, because while the runoff rate is lower, it's not zero, right? So they still need to manage that liquidity outflow from a large digital base.
Right, so a nuance there depending on the deposit mix. Makes sense.
Yeah, it's not a completely uniform win straight away for everyone.
Okay. So broadly positive, some specific nuances. What about the bigger picture, the sort of regulatory mood music? What does this signal about the RBI's overall stance?
The general take seems to be that this points towards a more, shall we say, benign or accommodative regulatory outlook.
Hmm. Less burdensome, perhaps.
Potentially, yeah. Easing the LCR suggests maybe a bit more flexibility from the regulator, maybe easing up some of the compliance load banks are facing. For investors, that could signal a more stable environment.
And when do these changes actually kick in? When do banks have to fully adopt these new LCR calculations?
So it's being phased in. The final effective date is now set for April 1st, 2026.
2026. Okay.
Yeah, which is actually a delay. The RBI governor, Sanjay Malhotra, had mentioned it was previously targeted for March 2025.
Ah, so they've pushed it back a year. Gives banks more time to adjust, presumably.
Exactly. More runway to adapt their strategies and systems.
Okay, so we know what's changed, the general impact. But for someone thinking about investments, which banks are really expected to be the biggest beneficiaries here? Who gains the most from this shift?
Right. This is where it gets interesting for potential investors.
Yeah.
The analysis suggests it's mainly the public sector banks, the PSUs,
Mm-hmm.
along with the older private sector banks and the really large private banks. They seem best positioned.
And why them specifically? What's the mechanism there?
It mostly comes down to their deposit base.
Yeah.
They tend to have a larger share of those trust deposits we mentioned earlier, the non-financial entity ones.
Ah, the ones where the runoff rate dropped from 100% to 40%.
Exactly. Under the old rules, they had to hold a lot more liquid assets against those deposits because of that high assumed outflow. So bringing that rate down to 40% frees up significantly more capital for them specifically.
Got it. That makes a lot of sense. Are analysts naming names? Any specific banks often cited as likely gainers?
Yeah. A few usual suspects pop up.
Mhm.
SBI, State Bank of India, and HDFC Bank are often mentioned, just given their huge deposit franchises.
Right, the sale players.
Bank of Baroda is highlighted as a key PSU beneficiary. And among the large private banks, ICICI Bank often comes up too.
Okay.
Basically, banks with that scale and that kind of deposit mix seem well-placed
Mm-hmm.
to really leverage this extra liquidity. Could be a good starting point for research.
So for an investor, the logic follows. Improved bank health, better liquidity, maybe better NIMs that could potentially drive stock prices. Is that the connection?
That's absolutely the core idea. If these banks perform better financially, generate stronger earnings because of this, well, stronger earnings often drive stock appreciation, don't they?
Right.
Plus, if this does fuel more lending overall, as the RBI hopes, that lifts the whole sector, potentially boosting growth and making banking stocks generally more attractive.
So a possible strategy then could be to look closely at those banks, the PSUs or large private ones that have those big trust deposit bases or were maybe more constrained by the old outflow rules.
Precisely. Targeting those could be a smart approach. And, the feeling of a more stable regulatory backdrop doesn't hurt either. That adds a layer of longer-term positivity.
Now, usually there's another side to the coin, or at least some caveats. Anything in the sources that acts as a counterpoint or something investors should keep in mind?
Yes, a couple of things. One is the way government securities, GSECs, are valued for LCR is getting a bit tighter.
How so?
They're now using market values with haircuts, basically slightly reducing the value assigned to them.
Okay, so a small negative adjustment there.
Yeah, but the consensus seems to be that the big liquidity boost from the eased runoff rates should more than offset this GSEC valuation tweak. The net effect is still expected to be quite positive.
Right. Anything else?
The other, maybe more subtle point is just observing how the RBI's stance evolved. We mentioned those earlier, potentially much stricter drafts.
Uh-huh. The 5% extra digital runoff idea?
Right. The fact that the final rules are more relaxed suggests the RBI was, well, listening to the feedback from banks. There were articles out earlier in 2025 talking about how super strict norms might actually hurt credit growth.
Ah, so this could be seen as the RBI balancing prudence with supporting the economy.
Exactly. It suggests a regulator that's responsive, adapting based on feedback and potential economic impact, while still keeping an eye on liquidity buffers. That responsiveness could be seen as a positive signal in itself.
That's actually a really interesting perspective, a responsive regulator. Okay, so let's try and wrap this up. For our listener, what's the single most important takeaway from this whole deep dive on the new LCR rules?
I think the key message is, these revised guidelines are generally seen as good news for the banking sector. It means more liquidity, plain and simple, and that opens the door to potentially better profitability for many banks.
Right. And for anyone watching the markets, this could definitely create some interesting opportunities, especially if you look towards those PSU banks and the large private players with those strong deposit bases who might benefit most.
Exactly. It's probably worth thinking about which specific banks seem best positioned to really run with this, based on your own analysis and goals, of course.
Definitely food for thought. And maybe one final question to leave you with. If banks have more capacity to lend and operate, what other ripple effects might we see spreading out into the broader economy? Something to keep an eye on. Thanks for joining us for this deep dive.